Mergers and acquisitions, M&A. The sport of kings. The moment you get to stand on a podium, shake hands with another CEO, and pretend you know what synergy means. But then the dust settles. You have just bought a company for $100 million. You're feeling powerful. And then your tax accountant walks in, looking like a funeral director, and tells you that because you bought the company, you have also bought their latent tax misery. You did not just buy their assets, you bought their baggage. And the worst part? The accounting rules force you to take that baggage, wrap it up in a bow, and stuff it into Goodwill. It turns a clean deal into a mathematical crime scene where you end up recording a deferred tax liability on day one for assets you have not even touched yet. To understand business combinations and tax, think of it like buying a used car with character. Imagine you buy a vintage sports car from a guy named Steve for $50,000. You get it appraised. Turns out it's a rare collector's item worth $80,000. You feel like a genius. You made an instant profit. But wait. You open the glove box. Inside, you find a stack of unpaid speeding tickets tied to the license plate. The police do not care that you just bought the car. The car owes the money. If you ever want to sell this car or drive it legally, you have to pay the tickets. So, did you really get an $80,000 car? No. You got an $80,000 car with a $10,000 debt attached to it. Your real net value is $70,000. Since you paid Steve $50,000, your bargain is smaller than you thought. In M&A, those speeding tickets are the deferred tax liabilities attached to the assets you just bought. When you buy a subsidiary, IFRS 3 requires you to revalue everything to fair value. However, the tax authority usually does not care about your purchase price. They keep the asset at the old seller's book value. This is the crazy part. Where do you book the debit for that deferred tax liability arising because of goodwill? You cannot put it in the P&L as you have not started trading yet. You effectively say, I paid for a company, but I assumed a liability I didn't expect. Therefore, the premium I paid for this company is higher than I thought.